Good afternoon from the UK, and welcome to everybody to the webinar for a further instalment in Capco's Capital Markets series of events to inform and update on key industry events and initiatives. So my name is Owen Jelf. I'm the Global Head of Capital Markets for Capco, and I'm delighted again to welcome you. So we put this webinar together on SFTR, in part based upon our work in the industry today. And it's clear that although many firms have made good progress, there are still challenges both for the sell side, who are clearly intending to go live imminently, and the buy side, who are due to comply with regulation and go live later in the year, in October. So we're going to cover a number of topics, and it's going to be a very, panel-based discussion moderated by Tej Patel, who leads our finance and risk and compliance practice within Capco. We'll cover SFTR readiness, overall readiness, and the challenges there, challenges specifically for the sell side, and perhaps what the buy side can learn and adopt based on the sell side experiences. So, as I said, it'll be very question and answer based, and we encourage everyone on the call to use the tools at their disposal, the polling and the chat, to also ask questions, and we're aiming to get to those in the course of the next hour, and we'll have a hard stop at 1:30. So just to recap, Tej Patel will be the moderator and is the Capco partner that heads up our risk finance and compliance practice in the UK. So I'll hand over to Tej in a moment. He is supported by George Phillips, who is a principal consultant at Capco, who leads this offering in the EMEA region. And Simon Davis from a vendor group, Pyrium Systems, who heads up business development in that organisation. Obviously, has a great overview of the solutioning for SFTR as a result. And we also have a number of industry bodies represented for the topic. We have Pete Tomlinson, who's a manager for the post-trade and prime services at AFME, and obviously AFME has played a key role in the solutioning around SFTR. We have Adrian Dale, who is head of regulation and market practice at ISLA, and finally Richard Komoto, who works with ICMA on repo issues related to this legislation. So hopefully that is a full and complete panel for the discussion. So without further ado, I'll hand over to you, Tej, to get us going.
Brilliant. Thank you, Owen, and welcome to everyone who's joined either on the web or on the phone. So as Owen said, if there are any questions, please put them into the Q&A section and we'll aim to get through them. Any we can't get through to, we will make sure we follow up post the event, so please get those questions in. So in the interest of the conversation, I've got some questions that I'll be asking the panel as we go through, but please send through your questions. So before I get into the first question, we did ask something at registration. So we asked, with the additional 3 months, what did firms potentially do with that time? So as you can see, the majority, or by not a huge amount, but 47% said additional testing, 2% said they focused on pairing and matching testing, 6% focusing on tracking and tackling the late level 3 guidance that was published. And we have a fourth group, which was the second highest at 45%, where they said the delay did not apply to me. I suspect that it's majority of them being non-sell-side firms, but look, it'd be very interesting to hear, does this kind of reflect what you've seen in the market?
Yeah, thank you very much. So our testing's progressing well with our partner for SFTR, IHS Markit. Clearly, the extra time has been well used by firms with more testing, additional preparation. We're testing, we're now doing production testing. We have been for a while, and we've seen that increase quite dramatically over the last few weeks as more firms go into the pre-production environment, and that continues to increase. And we've seen a big demand for more analysis, root cause analysis on problems, more training on the solution that we're offering, and firms have been able to focus on those trickier edge cases, and importantly looking at the impact of processing life cycle events, and how to deal with all of this reporting and the obligations as part of their BAU processes. So just to give you an idea of some of the figures we're talking about, over the last 2 months, up until the end of May, we've processed 54 million records through our pre-production environment, and so that's a significant volume. Some of the main, the majority of that volume is on the trade and collateral reporting, as you'd probably expect, then on the valuations, lesser extent on margin lending and reuse report submissions. I think that reflects the position level reporting that both of those functions require, and also some of the fact that they're simpler tables. There's less complexity within those tables as well, so there's probably a bit less testing going on from that perspective. And we've seen a big increase in terms of the agent lenders testing in order to make sure firms can get access to their information of their allocations that they're processing on. And the focus really has been around firms using our solution for pairing to make sure they can test the UTI sharing process. The main issues around that are particularly around reference data sources, so LEIs of their counterparties, making sure they're up to date, as well as the timing of the bookings. And then the other focus really has been around making sure they can get an ACK at the trade repository. So in our production environment, 80% of the trades going through are acknowledged or ACKed. That's up from 68% that we saw in the UAT environment. So that's definitely progressing well and going in the right direction. The majority of those are on the trade level, and then the valuation and collateral in that order. And we can talk a little bit about the main challenges. It's mainly around missing data fields and inconsistency in the quality of those data fields. So particularly around LEIs, missing LEIs of the reference data, and firms grappling with some of the complexity in the validation rules. So the conditionality in those validation rules, and making sure based on the trade type they're submitting, they've got all the data to be able to submit. So definitely more to do. It's ongoing. We're testing as close to go live as possible. It's interesting, in a previous discussion, one of the trade repositories advised that they saw that at this stage in the testing, there were much better ACK rates going through than compared to similar regulations. So that's very encouraging, and it's definitely worth buy-side firms taking advantage of this and the lessons learned, and talking to their sell-side counterparts about some of the nuances and the challenges in this as well.
Brilliant. Appreciate that insight, Simon and George, on what we think firms will have done. So moving on to kind of the next, which kind of leads on, right, in terms of the from sell-side firms. If we kind of focus on some areas of challenges, so one being kind of late delivery of the level 3 guidance. I don't think anyone would disagree with that. So it'd be very interesting to see where we think firms are currently actioning level 3 guidance. And clearly there's going to be a challenge to complete everything. So it'd be good to provide insight on what you can do in the run up to go live, and then more importantly, what do you do with the level 3 guidelines post go live. So Richard, if I may come to you, so it'd be really good to understand what you've seen around this topic.
Well, to get straight to the point, there has been recent guidance at level 3 on variation margining for non-CCP repo or non-CCP SFTs, and also the reporting of fails. Now, the guidance has arrived in May, so firms have built, and this means there's really no chance of what are quite fundamental changes being implemented really any time within the next 6 months. So it'll probably fall into next year. So that's fairly typical of the problem. There is a lot of coming back to. But I think the real problem is that there are so many uncertainties, so many contradictions, and so many structural faults in the whole regulatory framework that things are going to continue to change for some time, and we're having to sort of really, build houses on sand here. Given that ESMA is under-resourced both in terms of bodies and expertise, and from past experience, we can say that clarification is not going to come very fast. So after the first go live date on 13th of July, I think we've got a very long path ahead of us where we're going to have to keep at least tinkering, but sometimes dramatically changing what has to be reported. So the level 3 is only the tip of the iceberg. I mean, the problems that emerge there are often due to the fundamental design faults at level 1 and 2. And the level 3 guidance presents a challenge in itself. I mean, to call it clarification is be some kind at sometimes. It's often very confusing. It's riddled with errors, and it perpetuates the contradictions that we've seen between level 1, 2, and 3, and between level 3 and the ISO schema. So it's a very sort of unsettling environment to have to operate in. Firms have got to keep track of the discussion, and you've got to remember that a lot of the clarification doesn't come in the form of a new guideline or a Q&A. It comes in an email to a market association. It comes in the form of telephone conversations on various working groups. So extremely challenging to deal with these problems.
Thank you, Richard. Adrian, if I may, to get your view on this.
Yeah, good points. Actually, I'm gonna sort of dovetail a bit with what Richard said, because it's absolutely correct. But let's come from a perspective of, and Richard mentioned the tracking of issues. It's something that we've had conversations with NCAs about, and we've been talking about it for quite a while, that if there is something that's not correct, or you think it's not aligned to the level 3, you have to track that, and you have to be able to communicate it to your national authority and have an explanation of why it's like that, and then have a remediation plan, some way of correcting the thing. And of course be mindful of the fact that the default position for national authorities is you must provide full records, and they'll keep on repeating that back to you. So that means in practice that if there's something that goes wrong and you think you're going to be able to correct it in the future, then you're going to have to backload that data, because they're insistent on having full records. So then just talk about quickly some examples of those things. One of them Richard touched on anyway, which was about fails reporting. There is obviously, I've got to note, there is a difference between the repo and the security lending market in the way that we approach these things. The term we use for it is actual and contractual. So I actually raised it with ESMA, I think in about March 2019, because under the other regulations, we were looking at the impact of fails, and specifically in CSDR, the penalties that come along with that. So the question was, how do we report these things? Because up to that point, it looked like we had to report things contractually, which wouldn't represent the outstanding balance and why collateral had been assigned to something. So we started exploring that, and it's basically exploded into something that's there's still a very robust conversation going on. And anyone who's listening, if there's any query about it, and the best thing to do and the best place to have that conversation is to come back to a trade association where we're trying to create a consensus for our members in the market that we're in. So I won't loiter any more on that because it's a bit of a contentious one. I'll talk instead about another issue that people are going to have a problem with, and it was mentioned earlier on by Simon, and that's the issuer LEI. And I've been sort of leading a charge on this issue, which is the issuer of security has to have an LEI that's described on both the loans and the collateral. And for the collateral, the vision of ESMA and the NCAs is that if you don't have an LEI for the issuer, that collateral isn't acceptable. That actually has obviously ramifications, and so people are dealing with it in different ways. You can either look at your block of data that has all the different pieces of collateral in it and take one of those pieces out that doesn't have the LEI in it. That means you're not reporting something, which means a communication point with the NCA. Or you send a whole block, and of course, if there's one LEI missing, then the whole block gets removed, which is a point that I've been highlighting with the Commission and with ESMA, is that basically they would be the losers in that process, and that they wouldn't see data that they want to see. On the loan side, it becomes a little bit more problematic because NCAs are of the view that we don't want people to stop trading because it doesn't have an LEI in it, which some firms could take that view, or they could just carry on trading it and then hold it back. So we issued a paper to sort of get a feel for this whole thing. If you just Google ISLA and LEI, you'll see the paper comes up. And what we've also done is we've gone out to members. We've got all the unique ISINs that don't have an issuer LEI. There are about 45,000 of them when we first started. And we've been working with ANA, which is the numbering association, the Association of Numbering Agencies, rather, and GLIFE. And they've got a very good database of LEI ISIN combinations. And when we look at the data that our members sent to us of these unique ISINs that don't have LEI, we actually found that quite a few of them did have an LEI. So that means that the first point we have to look at is why haven't you got the data, and can you go and look at these the data that's available in ANA. I want to put some numbers around these whole things. So the ISINs that have been identified represent hundreds of billions of lendable assets. It's about 5%, ESMA noted it last year, about 5% of global availability in the security lending market anyway, which is 22 trillion, the total size of it we've got on our website at the moment. So ESMA were broadly correct with that. They did give us in January a little bit of leeway in that non-EA LEIs wouldn't go live in terms of validation until April of next year. So when we look at those numbers, about 77% of the non-EEA are concentrated in Japan and the US, Korea, China, Taiwan. And so ANA and GLIFE have been going to the numbering associations in those regions like QSIP and the Tokyo Stock Exchange, and they've actually given them that ISIN list, and we're seeing an increase in the number of LEIs that are available. So I'll finish up, sorry, I've taken a bit longer than I should have done, but to check the ANA ISIN database is very important, and where your data is coming from. And also be mindful that there are SFTR vendors who offer enrichment services, and they've got a better hit rate than some of the firms that I've received data from. Sorry, I went on a bit there, but this is the point.
That was very, very insightful, sir. I appreciate that. George, do you want to kind of talk a little bit around what we've seen practically from how do you prioritize level 3 guidelines, and clearly not all of it can be completed for go live when it comes to the sell side?
So I think Richard and Adrian have really pointed out that there are still some challenges, whether it be with fields, but equally the level 3 guidance. And what's really important here is that firms have full regulatory traceability on all of the text. So that's not just the level 1 and 2 text that covers the fields, but also the level 3 text, which is the guidance. And what that will do is it will give you a full audit trail of your implementation effectively. So anything that was identified and addressed after go live, you've got that clear audit trail to go back and address anything that you may have got wrong, or anything that's been clarified since everyone's gone live. Not having that would effectively mean you just don't have that centralized view of what's been done, but equally how things have been done, which is kind of what the level 3 guidance advises on. So the main thing I think we would advise here is that all firms look to have that in time for go live, and that will really highlight what's been done, what's not been done, but also what's been done but not been done correctly, and that will effectively drive your day 2 book of work.
I can appreciate George for that, because I think that part answers a question we've had from Dean come in over the Q&A. And the second part of Dean's question is around sort of pairing and matching, right, and the challenges around there. So Simon, would you mind kind of talking to us a little bit around what your advice to firms are where you're struggling around pairing and matching?
Yeah, absolutely. So you need to decide from a reporting perspective, what you're prioritizing in terms of getting the data in a timely manner or in the quality of the data to the trade repository. In order to meet your reporting obligation, the goal is to get that ACK at the TR in time with the right data that accurately reflects your books and records. The trade repository will then pair that trade if both sides are in scope. And in order to do that, they need a common trade identifier, a UTI, in order to pair that. They need the correct LEIs from both counterparts, and they potentially need the master agreement depending on what they're pairing up. So really, the priority for firms is to make sure that those fields are in line. Now, there's a huge challenge with UTI sharing. One side of the trade has to generate it and give it to the other side of the transaction, again, if they're both in scope. And that was a huge challenge in EMIR. It's part of the problem why there were so poor pairing rates at the start of the EMIR go live. And that's certainly something we've been trying to address as a solution provider. So it's how you're going to agree who's going to provide the UTI. Do you rely on the waterfall, in which case many firms will be both a generator and a receiver of UTIs? Or do you bilaterally agree to override that waterfall effectively, make sure just one side of the trade is always the UTI generator? And if you're going to go down that route, then you need to have an agreement with your counterparty. You need to be able to manage that ongoing and any new relationships that you set up. And you need to be able to rely on that effectively to ensure that you're either always generating the UTI or always receiving the UTI with that counterparty. So that's not without its complexity. So we do that through a pre-matching process. So we take the trade data. We don't need a common, a unique trade identifier between the two counterparties. We use the economic trades and an algorithm to pair the trades. And therefore, if one side is the UTI generator, we can effectively share that UTI with the other side to the transaction. So it removes a lot of this problem and a lot of the headache. And clearly with this, the timing of your bookings and the data quality is going to be critical to help with that pairing process, or that pre-matching pairing process, to make sure that you've got the UTIs or you're delivering the UTIs to your counterparty, and to minimize the exceptions from that process. And then you just need to look out for a few other things. So particularly if you're dealing with an agent lender, or if you are an agent lender, you need to make sure that any disclosure of the underlying beneficial owner is efficient, and that counterparties can pick that information up, again, with the correct LEI and UTI on, and the correct aggregated collateral data is provided. So that will help you if you focus on those handful of fields and the validation rules, and making sure that you can pass the validation to the trade repository. It will help with getting the trade to the trade repository, and then it will help with the pairing process when the trade repository's got it, because you should have the same data. So really that's the priority for firms. And then now it's really firms are looking at the root cause of their matching breaks. So whether it's static reference data, which is causing a lot of problems, again, LEI databases, whether it's counterparty or securities, are they relying on their own that needs cleaning up, or are they relying on vendors such as ourselves to provide and enrich that data? Problems around master agreements, again, that's not always matching. It's normally static reference data that needs to be set up and enriched onto the trade. Things like the validation rules and the conditionality within those rules. So if you book a certain type of trade, making sure you've got all the data that is required for that trade, and that's not without its complexity. It's reasonably complex to deal with that. And then other things like net collateralization, execution venue, there's a lot of breaks on those fields. Providing you've got the right standard data, it should still get acknowledged by the trade repository, and it's just making sure you look at the root cause and fix those over time. And then firms are prioritizing what they're looking at. So not all data is reconciled on day one. A lot of data isn't reconciled till much further down the line. And again, there's an opportunity to look at the root cause that's causing those breaks. Often it's the standard of the data, and that firms need to start adhering to industry best practices. So that will all help. And then the other thing firms need to just be mindful of is day one, you might have a pairing at the trade repository, but these transactions are open for quite some time in many cases, 90 days plus. There's a lot of life cycle events that happen on these transactions that affect the open position, and things like returns, rolls, terminations, early terminations, partial terminations, things like that, all affect whether the trade will continue to match further down the line. So you just need to be mindful of those BAU life cycle event processes. And the goal there really is to automate as much as possible. Can you standardize it, automate it, and remove both the miss bookings and the timing discrepancies on those bookings that will also prevent breaks that need to be dealt with at the trade repository much further down the line post the initial report being made.
I'll just jump in here and say on the question of UTI, if firms don't use an infrastructure or utility to generate one, they have to generate one between themselves. There is a process described in the recommendations produced by ICMA and ISLA on the sort of bilateral process that should be followed, and it includes some sample XML messages and CSV file formats that can be used to exchange that data.
Do you mind if I add a point in there as well? Sorry, I just wanted to add on to something that Simon was talking about. In that reconciliation, when we originally started having these conversations, we recognised that the vendors who do contract compare, like Pyram do, very well have a way of matching things together with quite a bit of experience. But the tolerance levels that were required by SFTR were really quite a tall order for the market to reach. So what we agreed to do is that let's prioritise those fields that we're going to have a look at, that members should focus their resource on, to narrow down the tolerances that are being used on them so they match with SFTRs. And so what we had is a working group with the vendors and the members, and we came up with a sort of a first cut of fields to be looking at to increase the contract comparison, the reconciliation, and there'll be further meetings on that, and we'll sort of make that into our best practice of these are the fields you should look at first. Thank you.
No, thank you, Richard, Adrian. That's very useful. George, is there anything you want to add to this point before we move on?
Yeah, sure. So I was just going to cover up how firms would approach this if they've not got an external vendor looking at this. So Simon kind of spoke about how firms do this, largely if they're signed up to a vendor like Pyram, who are kind of leading in the sort of the repo space for this. So there will be some firms that have not got external vendors to pair and match. As I mentioned, in the repo and stock loan space, we observe kind of prominent firms leading the way on that. However, there will be firms with kind of smaller volumes and less complex trade scenarios that are probably not using a vendor simply because they think it's something they could do without investing in the infrastructure. And really what we would advise there is you can ultimately break down the reportable fields into kind of three categories, I would say. The first is kind of the transaction details. And then second, you've got kind of the collateral / security component. And finally, just other static data, such as LEIs, etc. So for the transaction details, that should all be agreed by the trader at point of execution. And as Simon kind of alluded to, the tolerance levels, that there's really not much room for error here. So it's imperative that the trader is booking those to match the counterparty exactly. Equally, Simon alluded to any life cycle events that are being reflected differently will lead to kind of issues there. So it's important that emphasis is put on kind of the point of execution. So ensuring that the details put in are accurate. Equally, any life cycle events are reflected on both sides in the same way. So that's kind of the transaction component. You've then also got the collateral and security part. And here, really what we're saying is you've got an ISIN. Most of the rest is kind of static data. So things like LEI of issuer, jurisdiction of issuer, we should ultimately have the same things that counterparties are reporting here. So a lot of counterparties will be saying if the ISIN is correct, then a lot of that should fall into place. We have seen that that's not necessarily the case, and that will be where firms are using different vendors for things perhaps. So collateral type, collateral quality, we are seeing some issues on. And those are issues that we would expect to probably roll into kind of go live. And then over time, we'll see the situation start to improve there once we're seeing what the issues are. Final part is just kind of things like LEIs. So when you go and do your counterparty outreach program for things like UTI generation, you should really ensure that anything like that is agreed and you've got the correct LEIs that you're reporting for the pairing part of the process. So hopefully that's provided an overview just how you should kind of go about this. That approach will not cover every single field, but it's at least giving you kind of a starting process that outlines how that can be tackled.
Excellent. Well, thank you for that. I'll move on to kind of next part of the discussion and focus area. So this is really from a buy side perspective, right? So if I may ask, so what are the kind of key lessons that can be learned from the sell side that will be applicable to buy side, right? So if Richard, if you wouldn't mind going first on this, please.
Sure, yeah. So I think the first thing is you really need to make sure you understand your business, what you're transacting. A lot of sell-side firms have been quite surprised to discover the true nature of the contracts that they've been trading for years. And very often the people responsible for reporting don't have the market experience, the legal experience to really understand what's been going on. And quite honestly, a lot of transactions are structured in ways that make them legally challenging if anything went wrong. So you may have to get the lawyers in to look at some of the stuff you're doing if it's at all complex. But even at a basic level, you need somebody in the business who really understands the product and don't just assume that, yeah, we all know what a repo is, because it's not that easy, and securities lending gets even more complex. So product and business expertise internally to understand what's going on. And then I think I've referred to the difficulty of following really, if you came now to SFTR, you'd arrived in your firm, they said, you're going to be our SFTR expert, and you needed to read yourself in, you would have an almost impossible job because of the very disparate way this has all been put together. So connect with industry associations, and that includes not just you're a buy side, you connect to buy side associations, also product focused associations. So ICMA on repo, ISRA on securities lending, AFME on margin lending. And don't be afraid to ask those associations, if you're not a member, because you'll be the customer of somebody who is a member. And we spend a lot of time at ICMA, which has historically a sell side focus. People spend a lot of time on the task force worrying about what the buy side is doing. So please, don't be shy. Tap all the resources that are available. Not, the actual regulatory product is quite confusing. But for example, at ICMA, we have, I think, what's going to compete with the Bible shortly. Our list of recommendations is about 285 pages. We've got sample reports, life cycle mappings, all sorts of things. Make use of those. ISRA has the same, and so on. Make contact if you have got serious problems. Make contact with NCAs, either directly or by your association. The NCAs have been asked already to show forbearance on certain issues, and on other issues they've started to diverge, quite honestly, from the ESMA approach. But if you are going to lobby for understanding, don't moan about the difficulty, the cost, the fact that your systems are rubbish and it's a challenge for you. You've got the regulators won't be interested. Focus on the problems in the rules and the way that they're not realistic and don't reflect the way business is done. provide examples, provide hard evidence. And it's already been mentioned the need to document, document everything and have it ready to use. So I would say, those are the key things. Perhaps just to add on, again, it's already been mentioned, the regulation requires complete, accurate and timely reporting. And you may well have to prioritize, and I think a lot of firms have. And I think most are plumping for timely as the key priority. So you've got that sort of difficult decision. If you have got defects, then really you need to have a concrete plan how to get out of those problems if you're going to go and look for some temporary forbearance.
Thank you, Richard. No, that's a very good advice, right? That dialogue, early dialogue with the regulator based on challenges that the rules are posing, rather than just my systems or infrastructure is not up to it. Yeah, it's very, very sound advice. George, what do you want to add to this point?
Yeah, I think I'd add two things here, and they come back to kind of architecture. So essentially, the buyer side can learn a lot about the architecture that was implemented as part of the sell side. So firstly, they'll have a view on who the most prominent vendors are, and they'll probably have kind of some informal knowledge as to kind of how those vendors are working and forming. So in the repo space, we largely saw Market Pyram sort of in the UTI generation space, the pairing and matching service they offered. So buyer side can learn a lot about kind of what vendors they are and kind of how they've performed previously. So that's the first thing. And the second thing I'd kind of touch on is just process. So we saw the sell side do their implementation, and some of the challenges that they run into are things that the buyer side can sort of learn from and avoid. So for instance, a lot of the collateral static data was new to firms, so it's not something they would have stored previously. We saw a lot of vendors offering that enrichment at point of execution, which is great because it will mean that you've got all of the fields. But we quickly realized once we saw kind of life cycle events such as substitutions, it would mean that icing changes, and therefore all of the collateral static data would therefore need to change. So if you don't have all of that collateral static data in the upstream part of in the downstream part of your process, it would ultimately mean that you're not looking up every icing to check that you are populating the correct collateral data. So I think those are two important points that I'd raise that can be learned from sort of an architectural perspective.
Okay, thank you for that. Adrian, it'll be good to get your thoughts on this.
So both Richard and George have made some great ones. I mean, the communication point, absolutely agree. Counterparty and association communication, just like you said, Richard. And the preparation sort of alludes to the architectural and issues and the operating model, which has been a sort of a fundamental conversation that every firm's been going through, because no two firms are really the same. But then, if you're looking at from the perspective of the buy side, a little bit of a different experience, I suppose, and in that I would imagine that many of them should be asking the question about what their counterparty can do for them. There is that the option to do delegated reporting, and it's so. Does your counterparty do that, or is there somebody else who can offer it? There are other services out there that you can delegate the reporting to. So if they offer it, then you have to think about the cost implications or the benefits in terms of resourcing, for instance. The usual questions like, where does the UTI get generated and how does it get stored and that sort of thing. But an important point when you delegate is that there's a remediation of any problematic issues that come up. Who's going to fix those things? And then, of course, when you have this reliance on someone else doing delegated reporting, you have to think about, can they do it all? There's the obvious example of that they shouldn't be able to do it all is where we talk about collateral reuse, and perhaps you're going to talk about that in a little bit. So obviously in that one where you have to report a percentage of your total portfolio. I'll just finish up because I'm mindful of the time, is that from the buy side perspective, you should really be using the advantage there's an army of pre-trained consultants who understand most probably your operating model, what it should look like, and have just been doing it, a year plus worth of I'm not plugging myself, obviously, a year's worth of SFTR work. So a lot of the things that the industry's been struggling with over the past year and a half, 2 years, those things will be answered, and they'll most probably have some of the solutions for you. And there's a sort of a central point for some of that is that trade associations have been collating, as they've gone through all of this, a library of advice and best practices, which is becoming invaluable.
Very good points, because that is where you can benefit from those that have gone before in terms of implementation. So yeah, completely agree with that. Thank you. Just moving on to the next, and it's something you touched on, right, Adrian? So we're talking about the different reporting models that are out there. So you touched on full delegated. It'd be good to kind of understand a little bit more around assisted reporting models. So Pete, can I ask you for your kind of views and thoughts on that, please?
Yeah, sure. So, first thing, I guess at AFME, our focus has been exclusively on margin lending or PBs. So I'm answering very much through that lens. But the key message is really that it's very, very difficult for any buy-side firm to independently calculate all of the reportable fields. The complexity and volume of data that's required creates a very strong case for using some form of assisted or delegated reporting. So, AFME members, we've done a lot of work to be as aligned as possible. We've got some guidelines published on margin lending reporting, which outline the kind of general approach of our members. But for some fields, it's inevitable that different firms have taken slightly nuanced approaches depending on things like how their systems are designed, etc. So I guess, as we know, any buy-side client is typically going to have multiple PB relationships. So if you're not using assisted reporting or full delegated reporting, then you need to be mindful of all those potentially divergent methodologies and build out your processes accordingly. So that would be a very, very, very significant undertaking for any buy-side firm, and I think there's real value in using an assisted reporting or delegated reporting model to kind of simplify that process.
Brilliant, appreciate it. Thank you, Simon. Can I get your thoughts from a vendor perspective on kind of the merit and how this would work in practicality?
Yeah, so it's been mentioned before that the decision is going to be really reliant on your architectural, your target operating model considerations. Do you have a provider that can offer assisted or delegated reporting? Does your counterparty or your many counterparties offer delegated reporting services? What the control framework, what controls do you need in place? What legals, contracting provisions do you need in place to be able to take advantage of all of those? And if you do have providers that offer delegated reporting, I think the number of providers is going to be key. Do you have, if you're an asset manager, do you have multiple agent lenders, one or more, two or more even? Do you have multiple repo counterparties that can do the transaction reporting for you? And how are you going to monitor and control all of that? And it's worth stressing, you can delegate the act of reporting. Generally, you can't delegate the responsibility. It's still your responsibility. So the complexity of your business needs to be considered. Do you already have reporting capabilities? So particularly from EMEA that you can leverage and learn from interacting with the trade repository and how that can support the rollout of SFTR. But we are seeing a lot more interest for delegated or assisted reporting from buy-side organisations. And a couple of things they need to just consider, which is, first of all, the collateral. So if they are using multiple providers to deal with particular firms, they need to do collateral submissions potentially if they're doing net collateral calculations at the LEI level, and that can create some complexity. You've also got multiple people doing reporting on your own behalf. And then the reuse reporting needs to be looked at. So you need to report any reuse of collateral that you receive from an SFT in another SFT. And again, if you're doing that across multiple providers, how do you do that reuse calculation? And it's likely you're going to be the only person that knows the data to put into that reuse calculation. So it's not particularly complex, but you need to be able to do it, and then you need to be able to submit the report through to the trade repository. So there's just a couple of things to bear in mind. We're seeing with IHS Markit, we're seeing a lot of interest in delegated reporting, and we're supporting our clients. We have a modular solution, but we also offer an end-to-end reporting solution, and that includes data enrichment, the UTI sharing process, as I've just mentioned. And we can also provide our clients with a delegated reporting service if they want to offer it to their clients effectively. So we can support clients to offer delegated reporting to a broader client base if they want to take advantage of that. And again, we're seeing that interest is from particularly the prime brokers that are interested in that, the agent lenders that need to support their asset management client base. We're seeing quite a lot of interest from that perspective.
Brilliant, appreciate that Simon. Look, I'm just conscious of time. I'm going to see if we can get to some of these questions that have come in. So let's have a quick look. So I want to leave enough time for each of the panel to provide kind of final thoughts on this. So just quickly looking through what's been posted through, what came in after Dean. So we've got a question around what are most clients doing in terms of UTI generation. I think the answer was covered in there, but George, do you want to give a quick summary response to that, please?
Yeah, I mean, it kind of depends here, and we've kind of said that the most important thing here for a firm is to first engage with all its other counterparties to understand how they're doing it. For example, if you decide to have a UTI consumption at point of execution, but all of your counterparties supplying the UTI don't generate it till post-trade, then that's obviously not going to be any good. So what really needs to be done here is an exhaustive survey with all the counterparties to understand how it is they're intending to supply and consume it. And really that should be driving your decision for whatever solution you decide to do. I mean, we've kind of seen a mix of firms, some that are generating it at point of execution, others post-trade, and that's caused various problems in terms of certain firms are having to come up with some manual processes to be able to consume it at point of execution and generate it once a firm has generated it post-trade. So I wouldn't say that there's kind of much of a consensus here, but what I would say is you should be engaging with counterparties and assessing what the answers are, and that really should be driving your decision rather than just deciding something without having all the information to kind of make an informed decision.
Okay, look, appreciate that. And look, PJ and Vimesh, we will come back to you, and I see there's also a third question from Anonymous as well. I want to give, as I said, the kind of esteemed panel an opportunity to kind of come with their kind of final thoughts. So, if I may, Simon, would you mind leaving the listeners with your kind of final thoughts and advice, please?
Yeah, so I mean, this is a huge opportunity. I know it's a big challenge, but there is an opportunity here to have better data, better processes. The transparency is going to support and provide broader benefits to the industry and yours and everybody's businesses. But I think it's take advantage of the regulation, take advantage of the reg spend to deliver what you need and really future-proof your business. And if you haven't already started, you really need to be getting on with it.
Yeah, I think that's as ever. Appreciate that. Thank you. Pete, can I get your kind of final thoughts, please?
Yeah, I would echo Simon's sentiment to do as much testing as possible in the time that's remaining. Margin lending is a very different beast to the other types of SFT reporting. It's position-based rather than transaction-based, which in some ways makes it more difficult and in some ways makes it more straightforward. But it's important for anyone who has a margin lending reporting requirement to kind of understand those differences and the unique set of challenges. And as I say, to do as much testing as possible, as soon as possible, and to consider be assisted in delegating reporting models.
Adrian, would appreciate to get your kind of thoughts, please.
Yeah, to actually more sort of generally, and yes, SFTR, but also other regulations, I think, are forcing the industry to address legacy and historical practices like workarounds that were in there, which simply can't they just don't work anymore. And they're also the regulations, especially SFTR, then is pushing towards a data standardization that's been alluded to all the way through here. And that although the ISO message isn't perfect, it's a standard. At least people are starting to work towards it, and it will evolve into something that's better. It's also interesting to see the standardized terms and vocabulary that's being used now. So conclusions actually are getting more widely used by people. Unfortunately, the whole haircut and margin being interchangeable has been a bit frustrating, not least when it's been used by ESMA in a completely different way. Then the other thing is, you could see, if you look at the positive side of it, you could see the resource-hungry practices like billing and pricing, reconciliation, exposure management. All of these things are going to have a benefit from SFTR because of the timing and the reconciliation that's done. But I put a warning at the end of this, and it reminds me of a conversation I had about a year ago, I suppose, with a trader, and I was trying to explain to them what this regulation might mean, and I said the greater transparency means what you book is what the regulators are going to see. And he didn't like the idea of that and walked off. But that's the reality of it, is that there's going to be that type of oversight from regulators of the industry's practices. So, I mean, in some of those instances, firms are actually taking the approach that traders have to be educated on the impact of what they do. So there's some, overwhelmingly, I'm more positive about it perhaps than other people, but there are some things to watch out for as well.
Thank you. Very interesting. Richard, if I may, get your final thoughts, please.
Yeah, sure. Adrian just mentioned sort of standardization of terminology. That filled me with fear because the terminology in SFTR is quite perverse and often incorrect. So we might need to do something about that. I also fear that what we have is regulators loaded with data, very little of which they're going to give back to the market. And they're going to have to process this using all the sort of fancy modern computer-based analytical techniques that are available. I fear that we may have future regulation based on some pretty technically sophisticated but intellectually incompetent analysis. So imagine somebody with a powerful computer doesn't know anything about a repo or securities loan, how they will actually view this industry through the prism of their data. So we need to work on how the industry as a whole engages with regulators in the future, given this imbalance of regulation. Data will be extremely useful for larger firms. It will be, once they've thought out how to use it. But it's an incredibly expensive way of getting that data. However, firms have got to make the most of it. And just my final thought, SFTR, nobody very senior in the industry is really interested in this. It's, the guys down on the rowing benches who've had to do all this. And I think that's the problem as well, that there isn't the recognition at the most senior levels, even though a lot of money is having to be spent on this. It isn't something that really occupies the thought of chief executives much, and that really needs to change because it's going to have big implications, some of which Adrian mentioned, and they need to be aware of that.
Okay, and just for myself, I'm conscious of time, so I'm going to keep this very short. I think from an implementation perspective, my final thoughts are: concentrate on ensuring that you're producing the reports, they're hitting the trade repository, and just look towards getting that acceptance rate as high as you can before go live. A lot of the complexities and the problems that we spoke about in this, a lot of that comes from the level 3 guidance. There will be time to address that as part of your day 2 activity. So from a day 1 perspective, just look to ensure that you're producing reports and you're getting good responses on them, and everything you've not done, just ensure that that's being captured in your traceability.
Brilliant. Okay, George, thank you for that. And again, I'd like to thank the panel for taking their time out. It's fantastic to have had such a range of strong industry association representations. Again, thank you for everyone. Thank you for dialing. I'll hand over to Owen for closing remarks, please.
Thanks, Tej. Yes, I mean, I'd like to absolutely thank the panel for the articulation of the challenges and issues. Very insightful. Clearly, there is both a challenge and an opportunity for the industry to comply and adopt the regulation in the right way, and ultimately benefit from that. But thank you very much to Simon, Pete, Adrian, and Richard, and obviously George and yourself, Tej. And we look forward to talking on upcoming events. And as you can see on the slide, we have a number coming up, one tomorrow, as well as then a series in July. So thank you very much, everybody. Have a good rest of the day.